We intend to make this our greatest and most useful, interesting webinar yet. We hope you enjoy it. In my experience, there has been 3 essential trading journeys. The first journey, which is indicators, price action, market time frame, trading plan, and chart types. The second is automation, robots, code, clouds, and stability. And the third one's grid, money management, scaling. I'm going to pick a market. It's going to be the S&P. I'm going to explain it for anyone who doesn't know what the S&P E-mini is. We're going to build a price action trading system on it. That's going to be a 5 particular candles in a row type trading system. We're going to automate it, then we're going to grid it. You will see me take the one trading idea through these 3 journeys. So I'm just going to tell you what each of these journeys are, because I'll be interested to ask you where you are in your journeys. So indicators is when you grab someone's indicator that they've invented, try and make it work, or it's one of the standard indicators that come with your charting package, or it's building your own on default settings or wacky settings that you're playing around with. Price action, the merits behind that is people argue it's not delayed because it's price itself, so it's as real time as you can get, and it's just looking at the structure of price. The market is, are you doing futures or are you doing forex? Is your interest trading gold? That type of thing. Time frame, do you want to trade 1 minute? Do you want to trade hourly? Do you want to trade daily? Technical indicators on the 1 minute can be quite a challenge because they reinvent themselves quickly. 1 minute though is more thorough when you're doing a backtest with your structured settings. Hourly is a time frame I like a lot. Daily, you'll find is a lot more forgiving again as you sort of zoom out on your time frame. Trading plan, that's where you can sink years of your time. That's building a great plan, and one that has an edge and hopefully keeps that edge. And then chart type, which I put really as a part of your trading plan, but are you using Renko? Are you using Candle? Next is automation. That's the idea of taking the emotion out. You never fully take the emotion out, but perhaps you're trading something that occurs while you're asleep. Robots, that's writing them yourself or finding them on the web. Coding, that's learning how to code it yourself. Clouds, that's the virtual private servers or VPSs. If you don't trust your own computer to have a reliable internet connection 24 hours a day, you might want to host it up into a cloud. When you do that, there's good and bad clouds. So how reliable is your cloud? Does it come with software that keeps your codes running? If they fall over, can it restart them again? All that type of thing. And then that leads into stability. How stable is all the links in your chain? The third journey is about grids. So you enter once and then you could enter again if price goes against you, that type of thinking. Money management, only risking 1% of your account per trade. You would think that's something people learn on their first journey, but they don't. They actually learn, they hear that lesson early on, but they don't learn that lesson till way down the track. And scaling in, scaling out. So all the more creative exit types. Please type into the chat box what journey you're currently in, 1, 2, or 3. There's really a 4th, but I've left it out of here, and that's psychology. Psychology is really a part of all 3 of them, isn't it? Okay, thanks guys. That really helps me understand where you're at, so I can tailor today's event. At the end of every slide, if there's any questions, ask them as we go. Let's talk about the first journey. Indicators, price action, market time frame, trading plan, and chart type. Okay, let's start by getting the market out of the way, so to speak. So let's quickly do a crash course on learning the market, and then we'll get into the fun stuff, which is building a trading plan. We'll start with the S&P 500 E-mini. To understand an E-mini, we must first understand what an index is. You can buy an individual stock, such as BHP, not particularly exciting to trade from an intraday trading point of view. A company announcement from BHP could cause the stock to gap. To diversify, so you're not so exposed to the ups and downs of a particular stock, you could buy a group of different stocks. Intraday, very time consuming to buy a large group of stocks and then sell them again soon after. So to overcome this, you can buy and sell a basket that holds a good number of stocks. This basket is an index. As the combined value of the contents changes, so does the value of the basket. The S&P 500 E-mini, known by the symbol ES, is a stock market index futures contract traded through the Chicago Mercantile Exchange's Globex electronic trading system. An ES contract has a notional value of US $50 times the value of the S&P 500 stock index. The S&P 500 is a value-weighted index of the top 500 large-cap common stocks of the United States. The CME introduced the S&P 500 E-mini in 1998 because the non-mini version had become too large for many small traders. While the main S&P 500 futures contract was an open outright traded contract, the E-mini is all electronic. The speed of this new electronic transaction gave reason for hedge funds and large traders to prefer the E-mini over the big S&P. The E-mini has become the most popular equity index futures contract in the world, with an average daily implied volume of 140 billion USD. This means the S&P 500 E-mini is very liquid. The S&P 500 E-mini trades 23.25 hours a day, 5 days a week. There's also the NASDAQ 100 E-mini, which is the top 100 tech stocks of the US, and the Dow Jones E-mini, the top 30 stocks of the US. The ES moves in quarter increments, known as ticks. Each tick is worth $12.50 per contract. There are 4 ticks to a point. I think of it this way. The smallest that it can move is a tick, and when it moves 4 of those smallest amounts, we call that a point. And you can see on the right hand side there's numbers there, and there's a decimal point. Well, anything on the right hand side, that's the ticks, so that's the smallest increments that can move between the round numbers, and on the left hand side that's the point numbers, the full numbers. For a 1 contract position on the S&P 500, each tick is worth $12.50, so each point is worth $50, so every 2 points is worth $100. Let's say for whatever reason we enter 1 contract long with the intention to benefit from a rising market. We could enter at the conclusion of this green candle here at 903.50 with a 5-point profit target at 908.50 and a 2.5 stop at 901. In this case we make $250 or we lose $125, excluding brokerage. Never mind why we're getting in, I'm not talking about entry here. I'm just making the point of how much price moves and how much that equates to in dollars. Okay? In this example, our open fluctuated position went up $162.50, then down negative $87.50, close to our stop loss, then up to our profit target for $250 profit, at which point our position in the market was closed. Trading's not always about going long, which is intending to benefit from a rising market. The ES market allows you to enter short with the intention to benefit from a falling market for whatever reason, with a profit and stop. As intraday traders, our E-mini positions are normally closed out well before 3:15 p.m. Central Standard Time market close. However, if you do have an open position at 3:15 p.m., your intraday position will be classed as a daily position, and the margin required to hold the position will rise from intraday levels to daily levels. It's a good idea to be aware of this and make sure your account can support the difference. And if you've done your calculations and you're only risking 1% per trade, then this shouldn't be a problem. Now looking at the green, rollover day is when we jump from using this quarter's contract to next quarter's contract. The ES expires on the 3rd Friday of March, June, September and December. However, the rollover day, the day we start using the new contract, is 8 days prior, on the 2nd Thursday of March, June, September and December. Here we can see rollover day on the 0609 contract and the 0909 contract. Both contracts are running side by side to allow people to jump from one to the next. On the rollover day, the 2nd Thursday of the expiry month, you can see the volume has shifted to the new contract. If we draw a line at the 20,000 volume mark, you can see the new quarter has gained the larger volume. Not all futures contracts roll over on the same day as the ES. It's like in the movies when 2 trains are travelling at the same direction and our hero is on the roof of a train carriage and then jumps from one train to the other. The new train carries happily on and the old train comes to an end. Okay, so that's a quick overview of the market we'll be using today. Now let's get on with building our trading plan. First of all, keep yourself a journal. You can see your progress. You can note how you felt about each trade. So the date, the entry time, entry price, exit price, how many contracts, market or limit, long or short, the chart time frame, for us it would be 60 minute, the chart, the signal type, your brokerage, your overall P&L, and the psychology you felt with it. Psychology is important. Traders can struggle with opposite problems, both impatience and hesitation. It's a lifelong pursuit. You could have the greatest trading plan, but at the end of the day, if you don't believe in it or you don't trust it, you're not going to make much progress. There's two key areas of psychology that have been most important to me. Firstly, I check that I am proud of my trading plan. Now, pride as a human trait is ugly, but in your workmanship, it's a good test. If you're proud of your trading plan, it means something can go wrong and you can have a stop out, but you are so proud of the plan itself and the work you put into it, you're still happy to press through and let the probabilities work themselves out. Secondly, you have to be excited. You have to be excited by your trading plan, because when you're excited, time disappears and you can literally sink hours and hours into refining it and not notice that time go by. If you're not excited, I don't think you're going to stick it. And next, we need a trading plan, rules for entering and exiting the market. Give yourself a heading. Here we've got the ES, 60 minute, 5 candles in a row, and then what time window. So we've got 10 a.m. to 1 p.m. Eastern Standard Time. We're going to have a 20 tick profit, 20 tick stop. Now if there's $12.50 per tick, how much are we making or losing per trade? Someone type that into the chat box for me. That's $250. So then we have a heading, 5 up or 5 down candles in a row. We then write in more description what it is we'll be looking for. We take a little note of how it's been running over the most recent trades. We have a screenshot of what we're looking for, and then we might have a comment about particular scenarios where we don't touch it. So in this case, we've said a buy signal will be 5 up bars with 5 higher highs, 5 higher lows between 10 and 1 during the American business day. No trading on Fridays for the longs. For the sell signals, 5 down bars, 5 lower highs and 5 lower lows between 10 and 1. No trading Thursdays or Fridays on our shorts. So we're looking at the end of the 10 a.m., 11 a.m., 12 p.m. and 1 p.m. candle Eastern Standard Time, which is also the start of the 11, 12, 1 and 2 candle. There's an infinite number of indicator, chart and market combinations, a black hole of endless combinations. So to whittle down the list, we need to make sure that each component of our plan is significant. Significant elements of the market are more stable and don't reinvent themselves overnight. There's 2 reasons why new traders struggle. They don't understand how efficient the market already is, and they don't understand what is and is not significant. I've got a question for you. Are hourly charts, is price action, and is a time of day window significant elements? Let's look at a particular idea over the last 7 years and through the GFC. So here we're going long, and the time we went long, or the start of this candle, the time is 1 o'clock, so it's at 1300 hours in the data box. I've written here the time shown in the entry box is when the cursor is over the entry point, which is the start of the new candle after the signal candle has become valid. The computer time was set to Eastern Standard Time. Now, can you all see 5 green candles in a row leading up to that? 1, 2, 3, 4, 5. Let me just try my drawing tool here. So we have our 5 candles in a row. We have 5 higher highs. We have 5 higher lows. It wasn't Friday, so we're happy to take that trade. Now, how long were we in this trade? We were in it for 1, 2, 3, 4 hours, 3 hours, and we're out. And it did go past our profit, so we should probably keep some of these things like flip cards, and so we can go back later and decide to fine-tune our profit and stop. Let's have a look at this one. Where are we? We are mid-2006, so it might be good to check out how this thing's gone over quite a number of years. Let's see if we have those 5 red candles. 1, 2, 3, 4, 5 red candles. Lower highs, lower lows. In we get. Now what happened? Price sat around for 1, 2, 3 hours, and then it just dropped away. Okay, I've written it on the screen, but why do we have 6 green candles here? We've got 1, 2, 3, 4, 5, 6. Why didn't we get in an hour earlier? We could have, it would have been 12 o'clock. This first green bar is not a higher high and a higher low compared to the red candle. So even though it's a green bar, remember we want 5 green candles, yes, but we also want 5 higher highs, 5 higher lows. So to get that, we have to wait for the next 5 candles. So that's why our entry point is where it is. Okay, 1, 2, 3, 4, 5. And this is a loss, isn't it? And the other thing is we are holding this for daily positions, not intraday. We're not getting out of this at the end of the trading day. We're obviously holding these overnight. Okay, 1, 2, 3, 4, 5. There's 6 candles there. Remember the first one is not a higher high and a higher low. So that doesn't count. So we ignore that and we take the next 5 and we trade that. Now, question for you. Would this be a good opportunity for a trailing stop and a bigger profit? Okay, 1, 2, 3, 4, 5. Again, we ignore our 6th one because we wanted the high, 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 low. And then we had 2 trades in a row. Why did that happen? Well, when we got out of one trade with our profit target, at the close of that hourly candle, it was a valid new signal. And all the criteria were met again, which is 5 in a row, high, 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 low on the buys between certain times and not Fridays. And we had that again. So we're able to take 2 trades that day. Now we're able to take 3 this day. 2 wins, 1 loss. Look at that massive tail on that candle. Now in this situation, the time in the data box is the time that the first entry was. Now, we have a higher high, so why is this first candle not included? Because the low of it is not a higher low, it's an equal low. It's the same as the previous. Now, why didn't we include the candles prior to that? Well, you'll see that where we did take our 5 from, the best way to count your 5 is actually start from the entry point and go backwards. Then you see what you run into. So these dojis here, one of these dojis was not a higher high and a higher low, so that's why it actually started at this doji, which is a tiny green candle, and went from there, and then there was 2 trades in that. Again, I hope you're seeing that there's some real moves for decent profits, trailing stops here, if you were to go back through and think a little bit more about this to build something of your own. Here we have a short, so we have 1, 2, 3, 4, 5 red, and there was no chance. It turned on a dime and it just went against us, and you're going to have that. Don't try and build a trading plan where you avoid things like this. It's just going to happen. You'd be better to build a plan that expects things like this and can just handle them over time. Now, I find that really interesting. Look how much these markets are running. And at this point, I want to highlight a new observation. Remember when you're looking at something like this with flip cards, try and see that when you have a situation, a setup, what else is the market doing that day? And here's another observation I find. We have 1, 2, 3, 4, 5 candles in the way that I've mentioned, and then for the rest of that day, so each day there's a grey drop down line and the date at the bottom, so you can sort of see that's the trading day. In the 4th quarter, so after main market close, you can see that price has a thinking time. It's not really quite pullback time, but it is. It's a tiny pullback, but it's thinking time. Now if you examine that and see that this thinking time consistently over and over again, like that, you might be able to do something with that. So keep your eye out for every time we have 5 in a row and we're looking at this style of entry. I want you to look at the 4th quarter of the day, so if you're in America that's your evening, and study the fact that price has, no matter even the sharpest drop, I mean this drop is like a knife falling to the floor, isn't it? It still had some thinking time after market close. And I call that thinking time actually time when it actually goes back on itself a bit. What can you do with that? Have a think. So again, do you see the thinking time? Have a look at this. During the main sort of 9 to 5 business day, it was very much one direction, but then it had that thinking time again, didn't it? Okay, we've got 5 in a row, and they are higher highs and higher lows. When we hopped in, it immediately stopped out. Now this slide's very important because it never went any higher really. I mean, probably 5 hours later at this green point over here, it went a little bit higher, but really it hasn't moved any higher. What's interesting about this pullback through here is just how much it pulled back, because remember, we're going to be automating this and then we're going to be talking about grids on this. One thing you need to remember is when you apply a second or a third entry, times like this are going to sail straight through them as well unless you set them really, really wide. Okay, so this will serve us well when we start thinking about clever exits. It's one of the first slides we'll be going to examine. Roberto asks, is this 5 bars plan an example or a suggestion? These 5 bars is just to talk about, I guess, to spark ideas for you building your own plans. It's to get your creative juices flowing. It's also to show you more the process behind going and putting a plan together. Okay, here we've got 5 again, and this time we had another stop out and it just turned on itself, but it didn't pull back too much further, and then it rolled down that way again. Something to keep in mind for later. Something I like to see when I'm building a system is that my get out point is the turning point of the market as well. So we got out down here, didn't we? Did the market go much further than that? Not really. It actually started to turn from that point and head the other way. Now, when you see that your get out point is also a major turning point, that's a pat on the back for your system design. Let me explain why. When you go short, so with the intention to benefit from a falling market, you do a sell. To take your profit, you have to do a buy to get out, right? So you're doing a buy at this profit point. Now, if you're doing a buy, if a market's falling and then it starts rising, what has to happen to make it start rising? Well, there has to be lots of buying going on. So lots of profit targets have to be starting to be hit. So there's lots of buying going on from those. And lots of other people need to be getting in because they want to go the other way. So they're getting in initially with a buy trade where we're getting out to go back up the other direction. So there's 2 different parties. Those getting out from their shorts, they're doing buys. Those getting in, wanting to go long, they're doing buys. More buyers and sellers, the thing turns. So if your profit target is at these turning points, it means you're actually tuning in to what a larger bunch of the community is also doing. That's a good thing. So again here, we've got that turning point effect going. We could probably ask quite a bit more out of that profit, but I wouldn't want to in this case. Or if I was going to capture what I call a mega trend, which is then you can see the overall trend just kept on going and going, but your stops are going to have to accommodate that. Now, did this go much further below our entry point before it raised on up? Have a look. Went down there relative to our entry, not too bad. Now we started in 2006. Guess where we are? We're in 2009 and we're still trooping through. Remember, 2006 was smooth sailing. There's not much to trouble the markets, and then the GFC hit, and then we've had all the volatility through that. So I think it's a nice test period if you can build something through all that duration. It means you can deal with the high volatility of those troublesome times and some of the low volatility times we've had since. And I'll also just throw in this idea too. Prior to the GFC, we had some quite trending type conditions, and so trending trading plans I found did quite well. During the GFC, range-bound systems did quite well because we just had massive high volatility gyrations, and that's where I'm going to talk about the third journey with different and more creative exits can really help. And I think going forwards from where we are now, because things have settled down a bit, is I think really trending type moves will return again. And why that happens is a cycle. You'll see that everyone gets used to one style of trading plan, and then the cycle of the market changes. So everyone sort of gets used to the range bound and then changes back to trend again. It takes like 2 or 3 years, I find, for that change to happen, but just be aware of that, especially right now in our current conditions we're seeing. Really interesting. We fall like a knife, and then see that breathing period again in the fourth quarter of the day. Who finds that interesting? Okay, again we wanted 5 in a row with lower highs, lower lows. This thing could have gone a little more, but we were happy with what we got. And then have a look at it felt like a knife, but then there's that thinking period again. Now, is the thinking period going to be on the fourth quarter of every trading day on the S&P 500 E-mini. No, it's not. I'm talking about the situation where you have these 5 candle setups. You've got a particular thing that we're looking at, and you've got this other thing going on as well. And with anything you design, always look at what it is you're actually designing, but look around that day to see if there's something that's always going on those days as well. You might see there's actually something secondary which ends up being a better plan anyway. Okay, same thing again. Why didn't we get into this one earlier? It's the wrong time. Remember the earliest? This is the earliest hour we would do it. So it was the earliest valid hour. I have a question here that says, does this work on other time frames? What I'm looking at here is on hourly. I would say if you're looking at another time frame, you're going to need to look at a different number of candles in a row with your high highs, high lows. And you might have to look at a different time of day as well. Okay, we had an absolute up move, but then did we have a pause and a think after in the fourth quarter? Yeah, we sure did. Is our profit target also a turning point? Yeah. So when you're designing your trading plans, make sure you're hitting that turning point. So if we did a buy to enter, we're doing a sell to close. If our profit target is a sell order and other people's profit targets are sell orders, everyone's doing sells. Plus if there's new people wanting to enter to benefit from a falling market up here where we're getting out, they're doing sells as well to enter. So there's sells for us, sells for them, lots of sells going on. The sellers are overtaking the buyers and the price turns. Okay, so again, another pat on the back for plan design if your plans start doing things like that. I have a question here which is, how do you decide where to get out? I think a great way to choose where to get out is have an equal size profit and stop to begin with, because then it's purely just probability. So you want your trading plan to be working at 70% or more success rate. Then if you want a 2-to-1 profit to stop, 3-to-1 profit to stop, you want trailing stops, do it. It's hard. If you can make that work with your plan, with your sample set that you've got, great. Okay, so you start simply, like I mentioned, equal size profit and stop, and then you get more creative from that. What I'd also say in terms of deciding where to get out is you need to look at your risk profile. You can't risk more than 1% of your trading account per trade. Hopefully it's only 0.5%. And also, do you have the margin to be able to deal with holding position for that duration and time to hit that profit target? So on this example, $250 made or lost per trade is quite a lot for a beginning trader. Okay, so you might want to look at a different market or a different size profit and stop where the amount of money you make or lose is smaller, and obviously you're going to do this in simulation mode first until you get your confidence and prove you have a track record. Why do I select 5 candles instead of 2 or 3? Well, when I was looking at hourly on the S&P in this time frame, I found 5 was quite good, but I encourage everyone else to look at 2 or 3 or 7 and try some of the others. Somebody says here that they can't get a 70% success rate on a 1-to-1 ratio on their plans. No worries, talk to us and let us help you. It's an acquired skill, but keep at it. It's certainly something we want you to work towards. You may find that your style is that you have a different, instead of 1-to-1 ratio, you have a 2-to-1 or 3-to-1 ratio, and your percent return is a little lower. How long was this system tested? I will mention that as we go. Right now we're looking over 7 years or 6.5 years, and hopefully we've included every occurrence during that time. We can't promise it, but we have tried. Now this is very sad here. We have price moving up, and then we hop in. It's valid for us. And it does that thinking time, but the thinking time in the fourth quarter also unfortunately knocked us out, and it wasn't about to go any higher. I'll actually use this trade you're looking at right now to discuss a smarter type of exit that we can do. So here we go, there's 2 trades in the one day. That's quite nice if you can have something like that. Again, the market paused to think afterwards. We're now in 2011. We've had 1 win, 1 loss there. The question is, does that type of loss only happen 3 out of 10 attempts? Well, with the design of a 70% system, historically, yes, that's what you'll find. However, don't think that there's any logic to when the 3 happen. If you get a chance, Google some random probability calculators and things like that, and you'll see it's really interesting. You could have 30 wins in a row, but then you could have 9 losses in a row. Where the 3 fall in every 10 in a market that's seemingly random and crazy can actually be quite unnerving. So over the long run, you'd hope it pans out, but do be aware that when you're running a 70% system, it's quite interesting how it plays out in real life. I've had another question here. Guys, I really like these questions. Thank you for asking them. Do you decide where to put your stop only by 1% of your account? No. I'll design the trading plan to work however I can. I'll talk about some of the parameters I use when building that. Really, I'll decide to use it, okay, the plan after I've built it, provided I can only risk 1.5% of my account. If it's going to be more than that, I won't use it. Building a great plan is really hard, so I don't want to put any restrictions on that, but will I actually use it after I've built it? Well, provided I only risk 1.5%. Okay, 2 nice wins through there. So we've got 1, 2, 3, 4, 5. We're getting in at the start of our time window when we would trade, went quite a bit further, fell like a knife that day, and had that thinking time again at the end. Could have we let that thing run and got more profit out of it? Yeah, we could. We would need to do an educated decision here and say, okay, does letting the profits run on these things over time, is it a good idea or not? This hit your profit target, but only just. In real life, would have you got that? Depends if you got an absolutely perfect entry or not. If you're manually executing this stuff, within probably the last 3 or 4 seconds of the hour, you might want to get in on the previous hour in the last 3 or 4 seconds, because if the candles are generally established and the hourly candle is not going to change much in the last 3 or 4 seconds, but the new candle is going to do a lot in the first 2 or 3 seconds. And the reason is because a lot of automated systems that run on hourly charts, bang, their burst is on the hour, isn't it? So there's like a flood that comes in. So if you're trying to get in the first few seconds and you want to get in perfectly, similar to how your theoretical and hypothetical backtesting showed, that's something that may work for you or may not work for you, but food for thought, try it out for yourself. Sometimes when you see a little gap like that, don't be unnerved. That can be natural. Sometimes it's just the weekend that causes things like that. So here this was valid, but we waited the hour's first valid hour in our trading window is valid before we could take that one. A nice short through there. Hit our profit on the wick, but really reversed. Not a lot more profit out of that one could be taken. Nice turning point. Okay, so our profit area is similar to a lot of other people's profit area, and that's what you want to see in any of your plan design. It means you're tuning in well. Profit target falling like a knife and then stops and has a breathing patch. Do you use any indicator other than the 5 bars to confirm your entry? This plan is actually very simple, so in this case no, we're not using any other indicators, but you might like to use an indicator of your own. You'd want to check how that indicator went through all the samples though. So the first journey is about learning the indicators, price action, choosing a market, choosing a time frame, and building a trading plan. We learnt the market, which was the S&P 500 E-mini. We chose a time frame, which was hourly. We chose price action itself because there's no delay compared to an indicator, where there is a bit because it's a mathematical derivation of price. So price action itself, we went for something really simple. Simple because this is just an example today, but also because there is strength in simplicity. When we're talking about strength, we're talking about what's the ability for this thing to hold together going forwards into the unknown conditions in the future. Regardless of how well a trading plan has gone in the past, it's no reflection of how it's going to go in the future. You simply can't trust an individual trading plan on its own. We just showed you one trading plan based on price action, but you might want to have another 11 plans on hand to disperse your risk and spread your exposure. Your other 11 trading plans would be based on completely different entry rules and different markets. That'd be things that you've dreamt up, discovered, and put together yourself. And even this plan, we would want you to make your own variation of that. Have you ever tried to trade 12 trading plans at the same time? What are you going to do? Buy 40 computer monitors so you can see all the charts and trade all your plans at once? And when are you going to sleep? Will you make some mistakes? It's time to discuss trading journey number 2, automation, robots, codes, clouds, and stability, because this is how we trade lots of trading plans at the same time. So this is how we would code it up. When you code something up, your plan might be quite simple, but when you have to put your rules in black and white, you'll see it's another thing. So here's our rules ready for automation. If the time is 10, 11, 12, or 1, and it's not Friday, and we've had 5 up bars in a row, 5 high highs and 5 high lows, then we'll go long for a 20-tick profit, 20-tick stop on the hourly chart of the ES. If the time is 10, 11, 12, 1, and it's not Thursday or Friday, and we've had 5 down bars in a row, 5 lower highs, 5 lower lows, then we'll go short with a 20-tick profit, 20-tick stop. Calculate on bar close being true, which means based on the end of each hourly candle. So when we're programming it up, we can do some fun things like this. See how 5 bars in a row I'm able to just say number of bars up, number of bars down, up bars, high highs, high lows are all just set to true in the parameters. So it's actually not as tricky as you think. So the computer trades your price action trading plan while you sleep. Actually, it trades all 12 of your trading plans while you sleep. You can tell the computer to only trade between certain hours, or ignore particular days of the week, or even skip a month of the year. And we can tell it to dynamically change the size of our profit and stop loss depending on the size of the volatility itself. So our risk-reward ratio is relevant to the market volatility at that moment. You don't have to sit at your computer anymore waiting for a trade to set up. The computer does it for you. When you automate, you can quickly see in a matter of seconds how the system's gone in the past. I'll tell you what I look for when I'm doing this type of thing. I look at the average trade, so let me just get my pointer here. You'll see my average trade. Remember, we were making or losing $250 per trade. The average trade's 147, so that's the average over the sample set. I want to see that the average is greater than half of my profit target for a 1-to-1 ratio profit to stop. Do you see what I'm doing there? So you take 250, halve it, that's 125. The average trade has to be bigger than 125, and that shows that there's some stability and some strength to what you've built. Maximum consistent losers, I don't like to see that more than 3. I've set it to 2. Well, it's just turned out at 2 because of how we've built it, and 2 on the longs and 2 on the shorts and 2 overall. Trade count is 39. I've left it at 39 because 39 is not good enough. Over 7 years, 39 trades is rubbish. You need to have a higher signal count. There's a really, really easy way to get a higher signal count. I'm going to let you figure it out. There's an adjustment you could make to the limitations we've got on this trading plan. Think about it, and your trade count will go through the roof and not affect your performance that much. If you can figure that out, well done to you. You want to see a balance of longs and shorts. Have a look at the number of longs we had, the number of shorts we had. About equal. That's nice to see. Decent test period, 7 years, not bad, because you've got high volatility, uncertainty, and you've got calm trending times as well during that period. When you automate, you can quickly see in a matter of seconds the theoretical, historical performance, and if it's been consistent or choppy or running out of steam. I like to hold a ruler up to the chart and measure how straight the diagonal rising line is. I also want to see some losses in there and see how it's recovered. If trading is 90% psychology and 10% trading and you set it to auto, have you fixed 90% of your problems? You now have a new 90% problem, which is when's a good time set to the new next level? Which strategy do I want to stop using? Remember, you've got a whole layer of systems you're running at once. I've spent years talking about why I love to automate, but it's really been, I guess, the last 4 months where everyone's like, not because of me, but just in general, they've just said, yeah, automation's the way to go, and a lot of people getting into it to remove the emotion, speed up the backtesting. Have a look at the year-on-year trading championships around the world, and you'll see what was the best one year, all the top 10 are doing the next year. Have a look at the increase in trading volume year-on-year. I've shown it here through the 90s and then through the 2000s, just absolutely exploding. And the trading community is evolving and getting smarter fast. So the second trading journey is all about automation. I hope that's opened up your eyes. The third trading journey is where it gets interesting. It's all about smart exits and variable position sizing, grid scaling, and out money management. A backtesting result should give us an idea of how the system might go in the future. A trading plan should maintain its edge, but what if they don't? What if we get a price action signal that simply does not act like it has in the past? What if the market is actually highly efficient and at the same time seemingly random? The third trading journey is all about creative exits. If the market does go down, we might not take the loss. We might enter again up to 2 more times to give ourselves an average exit point. With this new thinking comes an increase in risk, but also new ways to manage and layer that risk. Remember to keep each complete trade to 1% max risk. You might find that some of these more intricate money management processes have a slightly larger risk than 1%, so be very careful to calculate your total risk amount for each trade. Remember how we went through all those signal setups in Journey 1 like flip cards? How useful will that be for working out what type of creative exit we want to use? So with this type of thing, what you could do is instead of hopping out here, you could enter just 1 more time, and your average point is actually over here. So it helps you get more profit, but it does make your losses larger. So you want to be just careful. If done right, this can be one of the most powerful things you can do. If done wrong, it can be one of the worst things you can do to your trading account. So guys, quickly, a note on money management. Please start small, only use risk capital, risk less than 1% of your account per trade, grow your account to a new level twice before trading large positions. The reason I say that is when you're on a real roll and you're doing really well, sometimes you can be sort of drunk with your success and step a little early to high contract amounts and things like that, and then just around the corner is a tough period. So I say grow your account twice before going to a new level, or wait till you're going through a really tough period, and if you feel comfortable then stepping up, well, it probably is more appropriate. Do make a serious study of money management. It is, I think, the biggest part of your trading success, and I find this quite interesting. I've been observing the trading world for so long. I will just mention a few things here. In 2001, Saxo Bank pioneered easy-to-use online trading as the internet became widely spread. 2005, we saw expensive charting software give way to good free charting that's built into modern platforms. 2006, automation became easy and stable with wizards helping people to automate. 2012, we saw trading education videos on YouTube become popular, trading rooms starting to decline in preference for automatic trade copy services. 2013, automation has become widely accepted. Brokers and platform providers ramp up their educational support. So that's my little timeline, Greg's trade from your own computer timeline. Layers. Don't try and have one trading plan that gets you where you want to go. Have a layer of systems running together. And tuning in. Remember how we talked about the profit targets being on those turning points? Also, efficiency. Be aware of just how efficient the market is. If you have a good trading plan that's actually losing all the time, you should be able to flip it and it wins all the time, right? But if you've built something that's a dud anyway, when you flip it, it still loses, and that's just an example of how efficient the market already is. So those are the 3 journeys. Traders, if there's any way we can help you with these 3 journeys, let us know. Check out our site. We have a 15-hour free course that covers the first journey really well. Do grab that. Drop into our office anytime if you're about. We also have a service where you can copy our trades. This event has been recorded, should you need to review it. Thanks traders, it's been a pleasure.